Welcome to the REI Diamonds Show with Dan Breslin, your source for real estate investment jewels of wisdom.
Welcome to the REI Diamond Show monthly market update episode for the current month of May 2017. I'm here now with our resident expert economist and wealth advisor, Paul Sloate, founder of Green Drake Advisors based in Wayne, Pennsylvania. Every month, Paul joins us here on the show and fills us in on the economic forces at work in the national and global economy and what those forces might be expected to do to the local real estate investment markets in the short and over the long term. This month, Paul presents some research on some indicators in the stock market that could indicate a coming correction, aka drop in prices of stocks and other assets. And he also talks about why real estate investors should be paying attention to these indicators and how they tie into real estate valuations. So let's jump right in. Welcome back to the show, Paul.
Hey, thanks, Dan. Happy to be back.
I'm currently in Philadelphia, which is odd for me, recording this episode, not actually with you in the same room, but I believe you're right outside the Philadelphia area, too, today on the main line, right, Paul?
That's right.
For those that
bring
missed
me
the
flowers.
Show, yeah, that's not going to happen. But for those that missed, the reason I was in Philadelphia was the gentrification presentation for the Philadelphia Ring meeting, and I had a few requests of some of the audience members asking if we could stream that event live, which we did not. However, I did record that event. You can look for that on a coming up episode here. But for now, Paul, it is May 2017, May 11th to be exact, to timestamp this episode. And I'm going to turn over the floor to you to give us the ins and outs of what we should expect or might anticipate here in the economy.
Well, that sounds good, Dan. So I want to talk about some things specific to real estate. And then I want to talk about some outside forces that may have an impact on real estate, which I think our listeners should pay attention to. So why don't we talk a little bit about real estate? Last time, I believe I was talking about costs and how costs are starting to rise. And there recently was an article in the Wall Street Journal about costs starting to rise in home construction. And actually, costs are actually rising across all areas of the commercial construction business. So it's not just houses, it's all kinds of buildings being built. But the fact of the matter is that costs are going up. And so labor is rising at about 4 to 5% for construction, and other materials are rising anywhere from 4% up to 15%. As we mentioned last time, you have to be careful what you're paying for the real estate you're buying because your costs are going to go up and your rents might not, or if you're even trying to flip houses, your costs may start to go up, and you got to be careful that they don't eat you alive before you can flip the house. So that's just something we would tell your investors and listeners out there, that this issue is not going to go away and probably over the long term will cause more pressure. So that's one thing we're going to talk about. Now let's talk about the asset prices, because as we know, the Federal Reserve has kept interest rates pretty low for a pretty long time. And what this has done at some level is push asset prices up well above long-term normalized ratios. And by long-term, I mean ratios that we would look at over 10, 20, 30-year time horizons. And so we're going to talk a little bit about that and what that might mean in terms of real estate. So let's talk about interest rates. So interest rates have been low and they've started to tick up. So one of the things we should realize is that if we have a 30-year mortgage and rates go up, the amount of house somebody can afford is less. And in fact, it would take them, assuming their income went up 3 to 4% a year, would take them several years before they would break even and could afford the same amount of house as they did if interest rates didn't go up. Well, that's one thing that's going to start going on. So, in terms of asset prices, the price of houses and other assets like apartment buildings and hotels and other kinds of real estate-related assets may stop going up. We would note that this is occurring at the same time as the costs on those assets are going up. So you have to be careful in that the actual value of your asset may not rise, and you may be facing more costs, so you got to be careful what you pay for things. So that's just something we'd absolutely pay attention to, because interest rates are going to go up over the next 5 years, and that means there will be pressure on asset prices. Now, the other thing we want to talk about here and be cognizant of is the fact that valuations for assets in general are very high. And what do we mean by that? So why don't we talk about what's going on in the stock market? And we're going to give you a couple of valuation metrics that are very long term. One of this is the ratio of the stock market value to GDP. That is somewhere around 125% today. Over the long term, and I mean over the long term, this has averaged below 100%. And the reason we mention this is because it says a couple of things need to go on with the equity markets. Well, either they can come down to 100%, dropping 25 or 30%, and therefore the valuation anomaly is corrected. However, we would point out that that would still be expensive from a historical perspective, and the equity markets probably wouldn't be cheap until they were something like 60% or 70% of GDP. Well, 60 or 70% of GDP is a far away from 125% today. So from a long-term perspective, this indicator is flashing a very bright yellow light on the equity markets, just as the equity markets continue to go to new highs. Now, let's talk about something else. Let's talk about something called the CAPE ratio. That's C-A-P-E. Was invented by a pretty smart guy named Robert Shiller, who's now at Yale University, and he possesses a website there that is free to the public, and he publishes his CAPE, also known as the Shiller PE. So it's got to be pretty famous and pretty well known to have something actually named after you. So what does CAPE stand for? It stands for cyclically adjusted PE. What do we mean by cyclically adjusted? We take account of the fact that economic cycles go up, they go down, they go sideways, but they don't go up in a straight line. So what the CAPE does is tries to look at what the PE would be if we averaged a company's earnings for the last decade. That's right, 10 years. And what's that indicator telling us today? And I think that this is a little more telling than the value of the equity markets to GDP, because the value of the equity markets to GDP is somewhat dependent on how much of the earnings stream comes from outside of the United States, and it's a much larger portion than it was back in the 80s and 90s, so we have to adjust for that. But the cyclically adjusted PE does adjust for this, and we can look at this on a very long-term basis. And according to the latest readings, it's somewhere around 29.2 to 29.4. That means the average stock is trading at over 29 times its average earnings for the last decade. Now, let's think about this in historical context. If we go back to 1966, which is the peak of the post-World War II bull market, the cyclically adjusted PE peaked somewhere around 23 to 24. If we go back to 1929, the cyclically adjusted PE peaked at 31 or 32. However, and this is a big however, those valuations only existed for a few months right at the end of the Roaring '20s bull market. So in other words, we're talking July, August, and September 1929. Excluding those 3 months, the cyclically adjusted PE is above where it was in 1929. Now, if we take a look at 2000, we can see what the tech bubble really did. The cyclically adjusted PE went to 44. So you could see there was a real bubble, and I remember selling things in 1998 and watching them double or triple after I sold them. And then, that was over the next 2 years, 99, 2000, and then in 2001, the bear market started. And by 2003, I was able to buy the vast majority of what I had sold at about 25% of what I sold it for in 1998. Now, the point of that story is that just because something's expensive doesn't mean it's going to go down in value. But what we know is true of public valuations is that over the long term, they converge with their intrinsic values. So that's what happened in the stock market. And while we don't know for the stock market today whether it's going to get more expensive or whether it's going to roll over from here and restore itself to a reasonable valuation, which would be somewhere around 15 to 17, or about 40% less than now. And at the bottom in '08, by the way, we were down around 12, to give you a sense, so that's a long ways. And in the bottom in the early 80s, we were down around 7 to 8. So, wow. A very long-term perspective, the market is not cheap. I would point out that the market in 1921 was around 5, and on a Shiller PE. So what happened is you had a massive move up in correction in valuation. But as often happens in the equity markets, instead of stopping at fair value somewhere around 15 to 17, it went all the way up to 32. So let's talk about this and what this might mean for asset markets outside of equities. So what's going on? What it means is that has spilled over into other asset classes. It has driven the value of real estate upwards, for example. Real estate is almost back to its pre-recession levels. And in fact, in places like San Francisco and Boston, real estate values are above where they peaked in 2007. So we've had a massive run. LA is almost back to where it was. New York went to new heights and then pulled back in terms of condos and co-ops in New York City. Some of the houses in the suburbs have yet to reach their prior peak, but they're making a good effort. So when we look at asset values, they have run up along with the stock market. This has been caused by the Federal Reserve having very low interest rates. Now, what's going to happen should those interest rates not stay ultra low, which we think is a reasonable bet over the next few years? In fact, we think it's more than a reasonable bet. We think it's a high probability that interest rates are going to drift upward. So let's think about that. And as we all know, whenever we have a pullback in the public equity markets, it spills over into other asset classes. whether it's real estate, whether it's commodities, whether it is some collectible like artwork. There are tremendous spillover impacts from the equity markets. So what might happen in any kind of serious equity market correction or even a bear market indicating a new recession coming is that there would be spillover to the rest of the asset classes. And for our listeners, real estate is the one that would be impacted the most from their perspective. And so what we would expect to happen is you would get a pullback in real estate values, and especially given some of the valuations today. So this is something that your listeners will need to keep a very careful eye on, because there can be significant impact. And in fact, if you go back to the last couple of times the equity markets took a spill, there was significant impact. So we are suggesting that the outside environment might start impinging on real estate and the economics in real estate. One, because interest rates are headed upward. Two, because costs are headed upward. Three, because outside asset classes have become overvalued, and so real estate looked relatively cheap, which meant real estate values were driven upward. So they are no longer relatively cheap. In fact, I would argue in many cases they are relatively expensive. So when you think about this, you have to think about, if you're buying a rental property, what happens if rates go up over the next 5 years, 2%? What does that do to my values? How much do my rents need to go up? What do I do about those rents if, as in Philly or New York, there's a lot of capacity coming online that's putting pressure on rents? So there's a whole variety of issues that need to be addressed in purchasing real estate. And while we are not negative on real estate long term, as we like it as an asset class and think it is one of the few classes that can provide true inflation protection, we are concerned that valuations over the short term have gotten out of whack with long-term fundamentals, especially when interest rates come back into line. So let's say interest rates go to 5.5%, 6%, or rates go up 2 to 3% in terms of mortgage rates. Well, that would mean you could have a decade where real estate prices go nowhere, even if incomes are headed upward, because the increase in interest rates would offset the buyer's ability to buy the property. And if interest rates went up, let's say 3%, and let's say instead of having a 4.5% cap on a property, you had a 7.5% cap rate on the property. That's where the public values are trading, by the way, at say 4.25% or 4.5%, or sometimes even under 4%, and you went up 3%. Instead of having a 22 to 25 multiple of your cash flow, you would end up with something like a 14 multiple of your cash flow. Now, I'm not that smart, but going from a 25 to a 14 multiple seems to be a pretty big valuation change. So as we look at this, we think that things have benefited over the past from a very long period of low interest rates that have driven asset values up, and that while interest rates could theoretically stay here a little while longer, the best we can guess is that interest rates, which have started upward, will continue on an upward trajectory over the next 3 to 5 years, and even longer, and that this will begin to compress valuation in real estate. And Dan, that is all I have for today. Do you have some follow-up questions for me?
The only question I had written down was I was interested to know, you said that the 1929 PE was 31 to 32, only in the few months before the crash took place at its height. So what was the effective PE, let's say, in the 12 months prior to that period?
In the 12 months prior, it was in the upper 20s. It was between 26 and 29. So it had a very rapid rise. If you go back and look at the market, it accelerated exponentially in late 27 going into 28 and 29 and had a huge run-up right at the end, just like happened in 99, 2000. If you look at what happened, things accelerated right at the end. And so it was in comfortably between 25 and 29 for that last 12 months.
And how long have we been hanging at that 29 mark now?
Well, we just got to the 29 mark, I would say just a couple of months. However, from a historical perspective, it's worrisome, and here's the other worrisome thing. If you look at the expected return over 5 years from this valuation of the Cape, the 5-year expected return on the market is, any guess?
Probably like 5%.
You're too high. It is 0. So your 5-year expected return is 0, with a high probability of a drawdown at some point of 30%. And we would note that the virtues of indexing are being espoused to the public, correct?
As have been for a while, yes.
Right. Do you have an idea of what percent of the assets in the market are now indexed?
Unsure.
Would you believe, according to the latest statistics we've seen, it's about 41%, either directly through stock market indices or ETFs. It's a very big number.
Does that mean they're not as safe as you're led to believe?
It means they're a lot riskier than you're led to believe. And so, at some point, there will be a reckoning where the valuation of the market and what the underlying fundamentals will support will come into line.
So that about wraps it up for me. This was an interesting take on our status, our indicator of where we're at in the stock market historically, and looking at those numbers in the context of some of the big bubbles that we remember, you know, the 99, the ones we learned about in history class for 1929, 1930s. Obviously, the 2008 bubble, according to the numbers, it looks like the stock market, and logically would be said so, that we're at the 11th hour here, maybe even 11:50 or 11:51 here on the clock. And when it strikes 12, it's like the party's going to be over.
Yeah, it's hard to tell. The one thing I know, having done this for a very long time, is that you never know when the top will happen, but you do know when the risk-reward ratio is not in your favor.
Are there any periods of time where it just didn't blow out with a huge correction as opposed to more of a slower correction?
Here's what I would say, is sometimes the initial correction can be 25%. Okay, so if we go back to the peak in, let's say, 1966 in valuation on the Cape, the initial correction took us from 24 to about 18 in the ensuing bear market, right there, right? Then we had another bull market, didn't do as well, and then we had 69-70 recession, and then we had the 73-74 recession, for those of us who remember. And so what happened is, when we had those recessions, so you got a bounce up in the Cape after that first bear market and came back to about 22, but then it dropped to about 13. And then in the ensuing bull market, it got up to about 17, 18, and then we had the 73, 74 bear market, and we went from about 18 to 7. So the initial drop in this valuation measure is not necessarily when it returns to normal, because if you look at what happened in 01-02, right, in the bear market, you went from about a 44 to about a 22. Then we rallied up to about a 26, and then we went down to 12 at the bottom of the bear market. And then we've had a huge run up here, and it's impossible to know where it's going to peak, but we do know that the expected return from here over 5 years is 0. And the one thing we also know is that there are significant feedback mechanisms from the stock market into the rest of the economy, especially into real estate investing. So to think that we could have a correction in the market or a bear market and it not impact real estate, I think would be against what the statistics say.
And it all has to do with the psychological positioning of all the buyers that are taking place. The psychology of the entire marketplace, I think, would be translated. Everybody all of a sudden is not buying everything, just that general pullback.
Correct.
All right. That about concludes the questions I have. This has been a scary one, Paul, but I do appreciate you coming on the show.
I didn't mean to scare. I don't think that the market's going to roll over tomorrow, but I do think that when the Federal Reserve gets serious about raising interest rates, there is significant risk.
Got it. Do you want to share your contact information with the listeners, Paul?
Yeah, sure. If the listeners want to get in touch with us, they should go to our website, www.greendrakeadvisors.com, and feel free to fill out the Contact Us form, and someone will get back to them within 24 hours. Or they can call our offices at 610-687-7766, and someone will return their phone call. Thanks, Dan.
Cool. Thank you for coming on the show, Paul. Really appreciate your time.
You're welcome. Take care. Speak to you next month.
And thank you for listening to this month's monthly market update episode of the REI Diamond Show. Are you interested in receiving an email notification when the next REI Diamond Show episode is released? You can either sign up at www.reidiamonds.com and get a bunch of cool bonuses, or subscribe through one of the podcasting apps, including iTunes, Google Play, and Stitcher. Do you have deals for sale? If you'd like me to take a look at them to potentially purchase, you can go to www.reidiamonds.com and click the link to send over the deal details to me. I personally review and read the information that is sent through that site. I am currently buying properties in the greater Philadelphia region, including New Jersey and Delaware. I am buying in the Baltimore, Maryland region. I am also buying in Chicago, Atlanta, and Tampa Bay, Florida region. So if you have a deal in any one of those markets, you can feel free to check out the site and send that information. We obviously buy as is and pay cash for properties that we can turn around and make a profit on. Thank you again for being a loyal listener of the show. Dan Breslin here. I'll catch you on the next episode.
Thank you for listening to this episode of the REI Diamonds Show with Dan Breslin. To receive email notifications of new weekly episodes, sign up at www.reidiamonds.com.